So the EU-China trade war is about to get worse, and it's really funny if you think about it. Europe has followed the US into yet another economic trap. First was the decoupling from cheap Russian gas. Now it's punishing Chinese EVs with import taxes. And what does that do? It removes affordable electric cars and drive prices up for people in Europe. But this has always been the plan, and von der Leyen made it crystal clear a year back.
From wind to steel, from batteries to electric vehicles, our ambition is crystal clear. The future of our clean tech industry has to be made in Europe. This is our task. Too often, our companies are excluded from foreign markets or are victims of predatory practices. They are often undercut by competitors benefiting from huge state subsidies. We have not forgotten how China's unfair trade practices affected our solar industry. Many young businesses were pushed out by heavily subsidized Chinese competitors. Pioneering companies had to file for bankruptcies. Promising talents went searching for fortune abroad. This is why fairness in the global economy is so important, because it affects lives and livelihoods.
However, she still doesn't recognize the problem. What is the genesis of the issue? The entire ecosystem of Europe is essentially anti-manufacturing. Energy prices are higher, supply chains are much longer in Europe, labor costs are easily double that of China, sometimes even triple. Even if you ban EVs from Beijing, it won't make EU industries competitive. You just force EU consumers to pay much more. 4 out of 10 EV imports into Germany today are from Chinese brands. And that's the most recent number. Consumers are voting with their money and they are demanding cheaper cars. Slapping a 20 to 30% tariff isn't going to change a thing. People still have to pay more and EU industries still won't grow. All this does is to invite China to escalate back. When BYD sells their Seal EV to Europe, they make a profit of around 13,000 euros. The new EU import tax for the company is going to be 28% in total, up by 18%. Going forward, the car will cost around 7,000 euros more in Germany to buy. But that is meaningless to BYD. Even if they lower the sticker price to Europe and absorb the entire tariff, they still make a profit of around 6,000 euros. That's still 3 times more profit than selling back in China. The tariffs are all about getting companies to reshore away from China back to Europe, but that plan isn't going to work. When you manufacture in China, you get to export quality products at a lower price, and that helps you compete and sell globally. In Asia and Latin America, China's manufacturing trade surplus is growing. That is the chart on the left. Companies in Europe and the US manufacture in China for these growing markets. It's no surprise that China is investing in these places as well. They are helping to grow demand there. On the right side, the biggest trade surplus growth is coming from Asia and Mexico. Europe is all the way at the bottom of the list. They have the slowest growth. The EU today might be an important destination for Chinese goods, but in the next 5 or 10 years, it's a whole different story. This is just like the sanctions on Russian oil. Demand from Asia will easily replace Europe, and the big loser will be the EU consumer. They'll be stuck with more expensive EVs. Now, China, of course, isn't going to take this lying down. They are now weighing a ton of economic punishments to hit Europe. China is now drawing up their list for economic counterstrike, and many countries are going to get clobbered. France and Spain will get hit. The German economy will also be in deep trouble. We must realize that China has to retaliate here. If they take this lying down, Europe will continue to push the boundaries. They'll keep pushing, pushing, and pushing. And that's why a trade war benefits no one. It destroys jobs and drives inflation higher, plain and simple. China's first target is going to be pork from Europe. The EU has an overcapacity of pork and Beijing is on the verge of imposing tariffs. The country that will hurt the most here is Spain. They exported $1 billion worth to China last year. Since 2020, China has become more self-sufficient in their food supply. They can outright ban Spanish imports and get alternatives from Brazil or Chile. This move will devastate farmers in the EU who are already protesting on the streets. During President Xi's trip to France, Macron gave him a gift: two bottles of cognac, a Hennessy XO, and a Louis XIII by Remy Martin. There's a reason for this song and dance. China opened an anti-dumping probe into French liquor. There's a good chance now that Beijing could punish the import, and this is a very weak spot Macron is afraid of. Beijing buys a lot of brandy, nearly $2 billion a year. And guess what? Almost all of them come from France. China raising import taxes or imposing a ban will hurt France the most. The legal lobby will be going after Macron. Thousands of jobs will be lost in the process as well. And this will crater his election campaign. Brandy, alcohol might make him lose the elections to Marine Le Pen. While those are painful, it's nothing compared to the horrors facing Germany. And that's why Habeck, the German economy minister, is fleeing all the way to Beijing. It's important we look at the business delegation being sent. No automakers are going this time, which is very bad news. It means they have given up and it's up to Habeck to convince Beijing not to punish their automakers. Volkswagen, Mercedes, these are some of the companies that depend heavily on China. Over a third of their sales are from there. There's incredible pushback from China's car makers to the Chinese government. They want the ministry to increase the tax rate from 10% to 25% for large engine cars. The auto lobby in China is like the favorite son today, the golden child. Beijing wants to build their EV base, so they have to listen to companies like BYD, Geely, and Chery. If tariffs come for Germany, it's all over. A 15% increase is enough to make their cars uncompetitive. And here are the top challenges for German companies operating in China. These are the firms already manufacturing in the mainland. The top two problems they face are price pressures and weak demand in China. Domestic competition is fierce, which is pushing down prices across the board. Secondly, demand in China is still recovering. It'll take anywhere from 6 to 18 months to get back on track. China increasing the tax on German cars is the end game. It will wreck the companies and prevent them from making further progress in electric vehicles. By imposing tariffs, Beijing is forcing German automakers to make a very difficult choice. You can either manufacture in Europe and lose the Chinese market, or you can build a plant in China and enhance the ecosystem there even more. It's a virtuous cycle that makes Chinese industries even more attractive. And a big shout out to our sponsor today, Indigo Precious Metals. When it comes to buying gold and silver, I trust Indigo Precious Metals in Singapore. They have made investing in precious metals safe, fast, easy, and simple for both small and large scale buying. I've been stacking gold for over a decade now, and I've learned two things when buying. You want to buy authentic gold bullion, and you want to buy it at the lowest premium possible to stretch your dollars even further. And I'm glad to say I found both of this at Indigo Precious Metals. There's a lot of uncertainty in the world today. We have geopolitical chaos and the values of fiat currencies getting debased. Inflation is not gonna end, and that's why I consistently buy gold to preserve my wealth. Indigo Precious Metals is a leading retailer in Singapore. They specialize in physical gold, silver, and platinum. They are my one-stop shop when it comes to buying bullion. Their prices are sharp, and they have the best brands on sale, and I can test the gold on the spot. So if you're looking to make your first gold purchase, Indigo Precious Metals is the best place to start. Whether it's 1 ounce or 1 kilo, this is the reputable dealer you are looking for. So take action today. Click on the link below and enjoy a discount on your first purchase with the code SeanFu. Start your gold stacking journey today. Volkswagen, Mercedes, and Stellantis are already exiting the EV battery market. The EU can pump in billions in subsidies, but the running costs make it virtually impossible to compete. China has a ton of capacity and they make the cells at a fraction of the cost. If Volkswagen sells fewer cars to China, their revenue will collapse. Where are they going to get the money for R&D to play catch up in EVs? It's impossible. And this is where the story gets worse. Yes, it can actually get worse. The geopolitical situation between Europe, the EU, and China is devolving fast. As if the trade war isn't enough, we now have NATO itself making a horrible statement. Stoltenberg just gave China an economic threat that the West could sanction their economy.
China is trying to get it both ways. China is propping up the Russian war economy. They are sharing a lot of technologies, microelectronics, which are key for Russia to build missiles, weapons they use against Ukraine. But at the same time, China tries to maintain normal economic relationships with European NATO allies.
So you think there should be sanctions, perhaps?
At some stage, we should consider some kind of economic cost if China doesn't change their behavior, because now China is the main supporter of Russia's war effort, war aggression against Ukraine, the biggest war in Europe since the Second World War, and at the same time they're trying to have a normal relationship with European allies, and this cannot work in the long run.
Now that this is out in the open, China is aware of NATO's intentions, imposing economic costs on Beijing for trading with Russia. Just sit back a bit and imagine your President Xi. Over the past week, you saw something historic and frightening. The G7 confiscated Russia's assets and Yellen justified the seizure. To her, it was not considered theft. The G7 using the money is legitimate because it's just the income generated, at least to the US. But something tells me that China doesn't view it that way. This opens up a whole new can of worms. Chinese money and assets in the West can also be confiscated, especially after Stoltenberg's threat. He just revealed the worst case scenario. What's the point of investing in Europe if one day your factories can get seized? Those are immovable assets on EU soil. If sanctions hit China, production plants could get confiscated. A recent survey from the China Chamber of Commerce shows investment appetite already collapsing. Because of the tariffs, 82% of Chinese car makers are less confident about investing in Europe. Not only are manufacturing costs higher, but now you have the threat of sanctions. Private companies could get caught in this crossfire. This is horrific for countries like Germany that desperately need to reindustrialize. What we'll see instead are more EU automakers leaving Europe for China. You have politicians targeting Beijing, but if we listen to the business leaders, they are far more realistic. Unfortunately, there isn't a U-turn today, not with the current set of leaders in the EU. The trade war with China is going to end horribly. This is a very big mistake. But let me know what you think. Will China hit back hard on Europe? And will they target German cars next? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.